It'll double from current levels. Price of gold.
Double from current levels.
Yeah, easy. I mean, look, if you go back, you just look at all the all the monetary, the ultra easy monetary policy, the quantitative easing, all the twisting and carrying on, operation twist, whatever else, and and all the printing. This thing should have been way above $3,000 already. It should have been above $3,000 a couple of years ago.
Forgetting about any narrative, forgetting about getting bullish on something. If you simply run through what there is out there to buy, and then eliminate that which doesn't make a whole lot of sense, that's another way, that's another approach as to how to build a portfolio. And if you do that, you can look at bonds and you can say, okay, does it make sense to go into bonds in an inflationary environment when we have some of the highest levels of debt in the world? You can answer that question for yourself. So you can tick that one off the list. Does it make sense to go to, say, into the S&P 500 when the Magnificent Seven make up the greatest percentage of the S&P 500 over and above any other sector that's happened in the past, including the dot-com era? Does that make sense? Because largely, where NVIDIA goes, so goes the S&P 500.
Chris and Brad from Capitalist Exploits have joined us once again. Fellas, thank you so much for coming on.
Yeah, thank you, Danny. It's good to be
Pleasure
here.
To be here, Danny.
Yep, I've been a member of your newsletter for quite some time. I think it's been 4 years now, and huge fan. We have the link to that down below, and we've also got a $1,000 discount for the newsletter down below. So I highly recommend Capitalist Exploits. Using them for 4 years. My personal experience, my portfolio has gone up about 300%. So I can't recommend it enough. So let's go ahead and get started. Chris, Brad, let's start off with Chris. What is your general view of the market at the moment? Just a very 60,000 foot view of the markets. Then we can kind of zoom in on some specifics.
Broadly, we have a stagflationary environment. We are experiencing and will continue to experience higher cost of capital. Higher cost of capital are terrible for bonds. They can be also particularly bad for certain equities, those that are indebted. They tend to be bad for equity markets, which are along the lines of, say, disposable income, things of that nature, because you've got this environment where your disposable income is falling as a consequence of your cost of capital going up, as a cost of living. Higher cost of capital are terrible, goes up. Everything that the folks are experiencing already. What you're just watching is, I think, the beginnings of something of the same nature, but much, much greater. That lends you towards, quite frankly, an environment where it's quite easy, at least Brad and I feel like it's quite easy to know where to be invested, because there's not a lot that actually protects you. The good old risk parity trade is dead. The 60-40 equity bond split doesn't work. 2022 proved that. We've been saying that for about 4 years. And so I would position oneself for an ongoing environment of the same nature.
Yeah, Brad, what's your kind of take on of the markets at the moment?
The strength we're seeing in commodity prices is just getting into gear. I mean, we've had years of underinvestment in those. On top of that, you've had this massive move towards monetary debasement. Central banks acting with what I call gay abandon, right? No fear in terms of what their actions will have for ramifications on inflation. We've been surprised that the gold price hasn't moved. Well, it's moving now, but it should have been way higher, a couple of years ago. Often these things, delays and lags, can be quite some time, but it's catching up. Years of underinvestment in your traditional energy sources, mentioned fossil fuels, which is going to lead to energy shortages, which will lead to higher energy prices, higher inflation, higher interest rates. Not good for growth type stocks. So your highly valued stocks with high PEs don't tend to do very well in a rising interest rate or rising cost of capital environment. And on top of that, you've got all this geopolitical instability, and goodness knows what happens when the price of oil bumps past $100 a barrel. All sorts of funny things will start coming out of the woodwork. When I say woodwork too, like we've been through a generation of folks, even like folks 40 years ago, where interest rates just kept on coming down, and no one's really known a rising interest rate environment for any prolonged period. I think that's going to capture a lot of folks out. A lot of what's going on right now in markets, world markets and world economies, is a result of very, very cheap or low interest rates and cheap capital. We would argue that if interest rates never came down the way they did in like the last 10, 15 years, ever since the GFC, you wouldn't have seen this massive push in towards renewables. Renewables essentially been on the back of very, very cheap money. So there's a lot of stuff will come out of the woodwork as rates start and continue to rise.
Yeah, you mentioned the precious metals there, and they've actually been top of mind for many investors at the moment. Gold's it's actually dropped below the 2,400 mark last time I checked earlier today. It looks like we're having a bit of a consolidation correction from the rapid move up. Same thing with silver. Silver, although mooning all the way up past $32 earlier in the week, has kind of corrected back down, still above the $30 range. But what's kind of your take on the precious metal space? I mean, gold is a $15 trillion market cap asset. So to move this thing the way that it's moved, it takes hundreds of billions of dollars to do so. So who is buying up this gold, and what's been the catalyst behind it? Chris, I'll let you take that one.
Well, the last decade, we've basically continued to see a movement by central banks into gold. It hasn't been retail buying. Retail's not really interested still. Even the commercials aren't particularly interested. Institutional money is largely still unallocated towards the space. So the buying has been predominantly in central bank world. And within the central bank world, it's predominantly, should we say, non-Western, India, China, Russia. Well, China produces a lot of gold, and they basically don't export any of that which they produce, and then they also import. So no one really knows for sure how much their hoard of gold is, but certainly they're an accumulator, as is India, as are many other countries on an ongoing basis now. So we're seeing other ones coming into the play, whether it be Hungary, Poland, sensing geopolitical conflict, I suspect, as well as monetary issues within the European Union, which is, dare I say, in a prickly, despicable sort of, not despicable, but they're in a position where things are coming apart very quickly. They don't have a consolidated bond market, and they're now entering a war with Russia. Wars are always inflationary. They require debt financing, and Europe does not really have the capabilities to do that. So it's not a surprise that you see individual nations sitting there going, maybe we just start protecting ourselves a little bit. So that's the buying that is currently in place. And then, of course, crazy little people, little hedge fund managers like Brad and I, taking advantage of what we see coming down the pike, but and we like to buy things early on and be very patient, because that's how you get the sort of rewards that we've luckily been able to do. So that's where it's coming from, as far as I can tell.
It'll double from current levels. Price of gold.
Double from current levels.
Yeah, easy. I mean, look, if you go back, you just look at all the monetary, the ultra easy monetary policy, the quantitative easing, all the twisting and carrying on, Operation Twist, whatever else, and all the printing. This thing should have been way above $3,000 already. It should have been above $3,000 a couple of years ago. Now you could argue, maybe there's been forces keeping the price down. Well, whatever. But reality always catches up. We look at the sentiment of gold. The old bull market. The John B. Templeton thing. So bull market's born in pessimism, grum skepticism, mature and optimism, die in euphoria. Where are we sitting with gold? Skepticism, perhaps. There's no optimism. I mean, people rather invest in Bitcoin and the Magnificent Seven and stuff like that, as opposed to investing in gold, let alone gold miners. Are you clinically insane? So, yeah, we've got a long way to go. And if you look at the price of gold, so here's the other thing, Danny. Yes, you can look at the price of gold in absolute terms, but you look at the price of gold versus the S&P 500, like it's nowhere near any peak.
Yeah, it hasn't kept up.
It hasn't kept up at all. No, so yeah, don't be. I mean, people are surprised when people say, "Oh, it could easily double." You know, the funny thing is, we look back on things is when you get a big macro trend that takes hold, it lasts for a long time. The upside and magnitude of these trends usually surprise everyone, and it'll probably surprise us how far it goes. So, you know, I think in me saying at a price that gold will double from current levels, well, it'd be nice to give you a time frame, but you know, I think
I wouldn't do that to you, Brad.
No, well, I think look, the essence of what we're trying to say here is there's a lot more upside to come before we have any hint of optimism / euphoria into this market, which would generally indicate it's sort of topping out. We're light years away from that. So the hard part is just to sit and wait this thing out. I mean, I'm looking at the price of gold now. I mean, you know, so it got let's say $2,000 an ounce. When was that? It was back in August 2020.
21, I believe. I want to say that was the first time we hit it.
Yeah, well, anyway, July 2020, I've got here on my chart. Anyway, whatever. So, what are we now? That's 4 years. 1, 2, 3, yeah, 4. It's been 4 years, 3-4 years. This thing went sideways, and only now started to move. So, you know, these things take a long time to work out. Patience is such a critical thing. I don't think fundamentals are very, very difficult. I think they're quite straightforward. The hard thing is just following them, because these long-term fundamental trends require lots and lots of patience.
Yeah.
Discipline.
Yep.
Discipline,
I know, Chris, you mentioned you had a chart that kind of looks at the gold and gold miners as a percent of total global capital allocation. We're at what, 1% today versus 20 to 30 some odd percentage from the 80s and prior. I don't know if you have that chart ready or not.
No.
Yeah. Yep. The same is true across the commodity space. But yeah, to be clear, it's currently as a percentage of total global assets, it's 1% in 2024. It's been as high as 30% in the late 40s. Look, a doubling takes it to 2%, right?
Yep.
5x is 5%. It's nothing. So, and you know, you go back to say the 30s when it was 20s, it was nearly 30%. 30s, it was 20%. 40s and 50s were around 30%. They didn't have anywhere near the issues that we've got today. You could argue that there were issues in the 40s with respect to World War, true. And you could also argue that that was why the allocation was significantly higher. But I'd argue that we've got a similar environment developing today. And we don't need it to go to 30%. Like I said, a doubling takes it to 2%. To reference what you just mentioned, Brad, the upside is significantly greater than the downside. And what you need to do as an intelligent fund manager, and everybody's a fund manager of their own funds, is to identify these sorts of trends and then position it within your portfolio to a degree where you don't have to worry about it. What I think many people do, which is I think a disservice to themselves, is they get caught up in one narrative and then they go balls to the wall, full out on that, whether it be gold. And there's plenty gold guys who've done this. You run out there, they say gold's the answer, gold's the answer, to the exclusion of looking at anything else. That's a danger too. So we're not sitting here saying it's only gold. And yes, we're going to have an inflationary environment and geopolitical conflict and all these reasons which make it asymmetrical in nature. That's true, but that also doesn't mean you're going to put 100% of your money into that. If you are, you're an idiot. So
Yeah. So
it could be copper that does it could outperform it. It could be, or we just don't know.
copper's been making all-time highs too. It's over $5 as a, well, it's 480 right now, but it hit past and beyond $5 earlier in the week. I think it made an all-time high there. So Dr. Copper's on the move. You know, oftentimes I like to think of these use cases out there like Venezuela, Argentina, Turkey, that have dealt with hyperinflation. And intuitively you would think that, the people of these countries would seek out gold and silver to kind of hedge against their inflation. But what ends up happening is that they start looking for dollars. Now, when the US dollar inflates itself away as well, you suddenly lose that option. This is kind of where I see the price of gold just going ballistic, is that when when the United States comes between a choice of, in terms of servicing its debt burdens, whether to default or to just inflate away its currency, I'm with the camp that they're probably going to inflate away the currency. And once that happens, suddenly the inflation around the world, people aren't going to be seeking dollars in the way that they are now and have been. So that's kind of what I'm seeing as a catalyst to drive this gold price to insane levels. Would you agree with that kind of analysis?
there's many factors in play here. One is, let me answer it this way, and it's the way that we've answered this question for many clients. Forgetting about any narrative, forgetting about getting bullish on something. If you simply run through what there is out there to buy, and then eliminate that which doesn't make a whole lot of sense, that's another way, that's another approach as to how to build a portfolio. And if you do that, you can look at bonds and you can say, okay, does it make sense to go into bonds in an inflationary environment when we have some of the highest levels of debt in the world? You can answer that question for yourself. So you can tick that one off the list. Does it make sense to go, say, into the S&P 500 when the Magnificent Seven make up the greatest percentage of the S&P 500 over and above any other sector that's happened in the past, including the dot-com era? Does that make sense? Because largely, where NVIDIA goes, so goes the S&P 500, right? And you're running at a PE of what, 69 or something? Whew, you're playing with fire. So that's the S&P, which is a broad market. NASDAQ, similar thing. You've got growth stocks, equity growth stocks. Equity growth stocks don't do typically well in an environment of constricted capital. Why? Because often they're not even profitable, or they're marginally profitable, but they're growing very quickly. In order to grow that quickly, they typically need equity investment. Equity investment comes in an environment of low rates when people have free cash flow and they're happy to throw it around. You take away those elements and that whole sector looks pretty damn bloody shaky. So again, you sort of tick off these things from the list of that which you could buy reasonably, and you see what you're left with. And often you're left with these companies in these sectors which are already profitable, they're turning the corner, and they are absolutely necessary for society to function. You can't have functioning anything without energy. I mean, we're seeing this playing out now with AI, where everybody's been diving into NVIDIA. And you've got now Silicon Valley turning around going, we've got a problem. You know what their problem is? They haven't got enough energy to power it because these chips are very, very hungry. They chew a ton of electricity and they go, oh, we haven't got the electricity. Imagine that. So the way that you're going to play the AI craze in the US is going to be natty gas and oil, and in Europe it's going to be coal. Most people don't realize this. The other component behind this, of course, is that all of these sectors which are asymmetrical have moats around them. They've got moats around them because there isn't the capital investment hasn't taken place for at least a decade, and is not taking place even today because people are cowardly and they don't want to invest into anything that they think is going to kill grandma or kill Greta might get upset and go and glue herself to a bridge, something like that. So
yeah, so let's go ahead
it's
and
easy.
pivot. Yeah, let's go ahead and pivot over to energy. So you mentioned these AI data centers that are going to run up the electricity bill like nothing else, and nuclear power, kind of fits the bill in terms of providing strong base load energy. Given the fact that uranium is at $91 at the moment, URNM is at an all-time high, the uranium miners ETF. Is uranium still an asymmetric bet in your opinion? Does it still have its asymmetry that kind of makes it alluring, or has the majority of the move already been accomplished?
Well, I don't want to say it was easy a few years ago, because it was frustrating as hell a few years ago when we first started getting interested in uranium miners in 2016. It took 4 years for these things to, yeah, we bought at the bottom, but no one told us it was a 4-year bottoming process. Anyway, so look, okay, so how much investment has gone into developing new uranium assets in the last 10 years? Not much. On top of that, what's happened at a few of the big key producers? So we take Kazatomprom. They've, because of low uranium prices, they high grade their assets. So they mined out a lot of the easy to get, low cost resources. A little bit like what Shale Oilers did with their, tier 1 versus tier 2 assets when the price of oil was down. They drilled out all the tier 1 assets, or concentrate on those. So now the bigger uranium miners are left with higher cost structures in their resources. You've had very little in the way of development, and now everyone's got this being their bonnet about how nuclear is going to be a great thing for net zero, etc. And it is, but it takes a long time to get these things up and going, and it is costly. Look, there's a lot more upside. Danny, there's a lot more upside to come in uranium miners, but yeah, it's been easy if you asked us about 2 years ago. Okay, so well, let's do a bit of a test here. So on the John B. Templeton continuum, where does uranium lie? Pessimism, skepticism, optimism, euphoria? Probably skepticism, late stages of skepticism, I guess. They're starting to get interested in it, but it's not widely talked about.
Yeah, it's still, I mean, collectively has what, a $50 billion market cap, and then the vast majority of that is just between Kazatomprom and Cameco.
Mm-hmm.
That's right.
The other thing that is worth considering and knowing about is that both CCJ and CAS have come out beginning of this year with their forward guidance down. CAS is down 20%, I think it is, where they've said, look, all these numbers that we told you we're going to be producing, yeah, sorry about that, it's not going to happen. Same thing with Cameco. So you're seeing supply constraints. And then the other component is that the consumers of uranium are your utilities. And within the cost structure of a utility, the cost of uranium is fractional. They don't care about the price. What they care about is the supply. They have to have the supply, because otherwise you've got no electricity generation. So they have to have the supply, but they don't care about the price. It's a little bit like putting salt on your meal. Do you care about the price of salt, or do you care about the steak? The cost of the steak is always going to be significantly higher than the salt. The salt can go up 10 times, but you're only using it, but it doesn't really matter. You're still going to buy salt to put on your food. That's where uranium sits within the spectrum of utilities. And so basically it's a resource that is price insensitive. And as a consequence, you can have very, very wild moves, and you do. So further to what Brad says, I think there is still a lot more juice left in that particular orange.
Yeah, I saw a post from Cuppy earlier this week, and he talked about how, when you look at these mining equities, whether it be in uranium or the precious metals, they typically see their big run-ups in the beginning and towards the end when speculative mania comes into play. the reason being is because they get, their profit margins get eaten up by input costs as you move up in this commodity bull market. The input costs of increased oil price, blah blah blah. That begins to factor into these producers and miners. Now, what's kind of the best way you think to play these metals? Is it through the mining equities, the royalty companies, or is it just the physical metals itself? In the case of uranium, that would be the Sprott Uranium Trust. What say you?
The same with the metals. Look, back to you think about what Kapi says. Why is it that you get this move at the beginning? In part, it's pure liquidity. When you've gone through a devilish bear market, as many of these sectors have, your liquidity dries up. The number of companies dries up. Everything dries up. And so you're left with very, very volatile assets. You could have $1 billion company that's now $200 million market cap. That's automatically going to be much, much more volatile. So then you start seeing interest coming into the space, and really there's not a lot to buy because the entire market cap of that whole sector is a fraction of that which it used to be. So you can have these big moves where it goes up 5x, and then it sort of starts consolidating, you get some profit taking and so on and so forth. And then the bigger move is also a psychological move. It's where your institutions and other players start coming in because they're like, oh shit, we really need uranium, gold, whatever it is, right? Copper, it doesn't matter. And so now they have to deploy the capital, and basically their board advisors, when they sit down and drink their Perrier water and decide what they're doing with client money, they say, no, we have to have an allocation to X, Y, Z, whatever it is, because look, it's already profited, it's already done well. So there's a validation that's already proven. What you got to remember is most asset managers and most asset management groups are filled with cowards. They don't want to be the first in because there's too much risk involved. They are prepared to have to justify their decision making. They're always covering their ass. So if you come to the table and you say, I think we should have an allocation towards gold or uranium or whatever it is your chosen thing, you need to justify that. The easiest way for people to justify that is to say, oh, look, over the last 5 years or 2 years or whatever it is, it's gone up X%. And these are the reasons why. People like a story, you can tell a story, and then if you're wrong, you can go, well, I proved it. I mean, I kind of got it wrong, but like it went up, right, before I came in. So there's a lot of factors as to why you get those sort of bumps across sectors and how they move. So that's just one thing to keep in mind. Like I said, we tend to buck that trend because we quite frankly don't have any board. It's Brad and I having a discussion about what we want to invest into, and we make the decisions, and that's what we do. And so we have the ability to do, frankly, what many of your listeners can do. They don't need us. They've got the ability to do it. They don't have to sit down with a board and justify their decisions. So that's a huge, huge benefit, and I'd suggest people take advantage of it.
Yeah. You also mentioned, back when we were still on the topic of AI data centers, you also mentioned natural gas and the oil and the various other hydrocarbons, coal. Let's go ahead and pivot over to that front. So natural gas, coal, you want to talk about contrarian play. No one is talking about natural gas. No one is talking about coal at the moment. Natural gas is sitting at 278, well off its highs in 2022. We did have a bounce back from the mid $1 level a couple of weeks back. So what are your views on natural gas? And you can kind of already see the big natural gas producers have, they're still at relatively high levels. So, what's your view on natural gas, and how do you play this theme, so to speak, given the fact that the producers are still kind of elevated levels from the top?
Well, I think natural gas at least in the US is to a large degree, well, the outcome there is to a large degree determined by what happens with shale oil, with the whole shale space. Now, it would seem to us that the shale industry, shale space, or what do you want to call it, is is either in the mature phase or very, very close to it. In fact, and then what it comes down to really is the Permian Basin. All the other shale areas are through the 50% utilization of the resource. The Permian Basin is approaching 50%. Once you get to 50% utilization, it's very, very difficult to grow on any consistent basis. You're essentially in decline. So if that is the case, we think it is, they'll be surprised as to the downside in terms of natural gas production, because there won't be so much activity in the shale oil space. On top of that, you've had this massive move in the US. They have positioned themselves for an endless supply of cheap natural gas. What they've done, they thanks to Obama and the previous administration, they converted a lot of their coal-fired power stations to natural gas. Okay, we're going to leave cheap natural gas forever. Let's use it. Fine. What they've also done is they are now exporting that natural gas as well, taking it, converting it to LNG, exporting it to Europe and wherever else. So we've got a situation where natural gas production will be increasingly difficult to grow, or at least maintain current levels. You've got an infrastructure that is based on having an endless supply of cheap natural gas forever in the US. So in the long term, the price of natural gas is going to go way, way higher. And on the back of that, so too will coal. And that starts making uranium fired power stations look way, way more attractive. It all sort of goes hand in hand. So that's our thinking there. But Danny, these things take a few years to play out. We're watching. Yeah. I think the big thing we're watching right now is just how the Permian Basin plays out in terms of the production profile. Already we're seeing, in fact, it's across the whole shale space, the energy density of what is extracted is decreasing. So yeah, production's still high, but the energy density is decreasing. So you're getting a higher degree of natural gas liquids as opposed to oil coming out of the ground now. So it's getting more gassy.
I see. I see.
Yeah.
And over time, once we continue peaking from the shale front, Permian Basin, you should start to see the American nat gas price through Henry Hub begin to converge with the international nat gas price. And there's a huge disconnect right now.
Yep, it will. It'll play catch up. But yeah, look, going back to the whole AI thing and data center thing, what they need, those data centers, they take incredible amounts of power. They need consistent power. They need baseload power, which comes from either three sources. So it can be natural gas, coal, or uranium. Like there's a bit of hydro here and there. There's a bit of oil here and there, but predominantly it's the big three: oil, natural gas, coal, and uranium.
All right, so let's
and
go
then on the
pivot.
uranium side, there's the infrastructure to get that in place is a decade out.
Yeah.
Yeah.
So it just leaves your hydrocarbons in the mix.
Yep.
You just got to, well, it's going to be unacceptable to build out coal-fired power to coal-fired stations to power these data centers. So these data centers, Danny, the essence of these data centers is going to take more and yet more natural gas.
I see.
Another source of demand for natural gas.
I see. So you mentioned coal. How's coal looking at the moment for you? I know coal and nat gas tend to track each other by looking at the chart. What's the prognosis on coal at the moment?
Well, it's just like it's the old. We said it a few years ago that it's going to be the what cigarette stocks did from the sort of mid to late 1990s until say 2015. Coal miners will do the same thing. Never enough. There's no substitute for coal. People go, what? Well, yeah, natural gas. Well, yeah, to an extent. LNG, yeah, to an extent. But many of the places in the world that demand electricity don't have the facilities to take on LNG. Don't have natural gas, pipe natural gas. So there's just no substitute for it. So as world economic growth continues, as demand for electricity increases in emerging markets, it's just a one-to-one relationship with the demand for coal. Now, okay, so that's a done deal. The demand for coal will be way higher in 2030 and 2040 and 2050. There's no question of that. The question is the ability to supply that coal. Where's it going to come from? And has there been any massive increases in the supply of coal? Look, we would say no. In fact, to the contrary, it'll be decreases. We've seen an interesting trend in terms of coal. The big coal mining, not big coal mining houses, the big mining houses, your Anglos, BHPs, etc. They've been offloading coal assets, particularly their thermal coal assets. And so smaller players have picked up those assets. They're still producing it. They're just getting. So what's happened now is a lot of the metal, the thermal coal is in the hands of less well-financed players. So your big, you take a big BHP, cash flows from different sources, diversity of sources of cash flow from different commodities. They can divert huge amounts of capital to develop different assets. So if they just really decide to develop a coal asset, yeah, no problem. But now that's not the case. There'll be smaller players. And so are the smaller players going to be able to borrow money at what cost to develop resources? Good luck on that one. I mean, the Australian banks have said no, they're not going to lend to coal miners to develop assets, so on and so forth. So the story there, Danny, is a question of supply when it comes to coal. It's not demand.
See,
and we think supply will surprise to the downside. And we have our feeling, call it what you will, is that China, the biggest consumer of coal in the world, a lot of their coal assets, the ore grades are declining. They're through the best of it. They're having trouble producing enough coal. It's like you've seen these big copper mines, in Chile and what have you, and they're huge. Well, that means obviously all that stuff's been taken out. It's the same, and now they're into, so ore grades are declining. It's costing more to get the copper out. It's the same as applying to coal in China. So no one's talking about an energy crisis due to lack of coal, but no, we wouldn't be surprised.
What about oil? Oil is, you talk about the supply side of coal. One commodity whose supply side is being heavily tampered with is oil. I mean, we've been releasing here in the United States, we've been releasing from our SPR, our Strategic Petroleum Reserve, for quite some time. And news came out just the other day that we would release more gasoline from the Northeastern Reserve as well, to keep the price of gasoline down. Now, in the short term, this might bring the price of oil down as demand is satiated. But over the course of the medium to long term, this is when you've created this environment where producers and aren't incentivized to actually produce oil at potentially these levels, as they would have at, relatively speaking, at higher levels. So what about oil? What's kind of your feeling on oil now?
I think solve the output for the Permian, you solved it all. So let's go back. We go back 15 or so years. And 15, almost 20 odd years. So where has 70 to 75% of the investment in developing oil assets gone? shale. So you take away the investment in shale, there's been virtually nothing invested in developing, your traditional oil assets, non-shale assets. So, as I said, you solve the outcome for the US shale sector, or in particular the Permian Basin, everything else sort of falls in place. We think that the Permian Basin is either at or near 50% utilization. Evidence now coming through of well pressures declining, evidence coming through of the decline in the energy density of the output, so more natural gas liquids than oil coming out, or at least the ratio is going more towards natural gas liquids than oil. So it's immature. It'll drift up. There is no substitute for oil. Be very, very clear on that. Life as we know it. In fact, there's no substitute for hydrocarbons. So oil, natural gas, coal, take that away. Life as we know it is gone. Now, I don't think that anyone in this world is willingly going to see one to go backwards in terms of standard of living. So demand for oil is going to continue to rise. So there's no, like as I said with coal, there's no question when it comes to demand for oil. It's going to continue to rise. Again, it comes back to emerging markets as well. They're going to want to have higher standard of living, and that is oil. Now, there are a few fields coming online in offshore Namibia, offshore in Guyana, but nothing offsets what's likely to happen with US shale.
Right. So I kind of want to bring it full circle now. Chris and Brad, I know you guys are two students of history. When we've had monetary resets in the past, what has typically occurred with all these various commodities? Has it been the norm that they move to the upside, in periods like this? What's kind of been the precedence? I'll let you take that one, Chris. Yeah. Brad, do you kind of share the same sentiment there?
Yep. It's a perfect storm. It's years of underinvestment in these assets and hard physical assets, and years ever since the GFC, reckless behavior by central banks, which will play catch up.
Yeah, and I kind of want to close things off by just showing this chart off to the audience really quick. I showed this out to you guys before we turn the camera on, but here you've got. Let me know if you can see the screen. Okay.
Yep.
So the bottom chart here is your commodity index relative to the S&P. Now, this is where we're at today. We're at a value of 0.11. At the very top here in the 80s. Now, I'm not saying we're going to retrace all the way back up to the top. You're at 2.33. And the chart on the top is just the commodity index by itself, not in ratio form relative to anything. Now, the interesting thing is that if you look at the last commodity super cycle, which was early to mid 2000s, you started off here and you rode it all the way out to the top. Your ratio, your commodity index relative to the S&P increased by about 7x, 600%. Now you look at the index individually, it's almost the same upside, 582%. Okay, so it's a 6x instead of a 7x. But that's because, you're dealing with a ratio. This is an individual value. So, my point is that, if we just have a very small retracement back up, I mean, this kind of implies that commodities have insane asymmetry, given where we're at now, because we're at levels that have been not seen since, decades. You go all the way back to 1999.
You're right.
When we're back at this level, notwithstanding the COVID crash.
It's going to surprise us. It's probably going to surprise Chris and myself how high this goes. And the asymmetry is, it's in the commodity, but we would also think that it's in the industries that service the commodity industries, like oil and gas services. If you think, the ability for those guys to actually deliver services has been decimated. Many have gone bankrupt. The capacity to drill these days is a fraction of what it was before. I think there's only about 2/3 of the offshore oil drilling assets available now than what it was 10, 15 years ago, so on and so forth. So it's fantastic. Like the asymmetry across here is the hard thing, Danny, is just being patient.
Yeah.
Gosh, you can well, for many of these things are taking off now, other things sort of lagging a bit. I gave the previous example of gold. It's sort of went nowhere for 3 years, 3.5, 4 years, or whatever. Now it's moving. It's like, how frustrating was that? Same with copper. Like, gosh, it's like watching wet paint dry, and all of a sudden, boom, off it goes. So, as an individual investor, your greatest competitive advantage is being able to have a level of patience that institutional investors cannot have.
That's your edge.
That's your edge. Simple as that.
Just, it's the old adage. Everybody knows this. How do you ask your average man on the street if buying low and selling high is the answer to investing, and I'll agree with you. They go, yeah, that's it. But very, very few do it. We highlighted this, I don't know, maybe 2-3 weeks ago in one of the issues. The average hold time on equities, it's subby, yeah. And so people don't even have the patience to wait for a year. The fortunes of a company don't change in a year. Certainly not a company worth hundreds of millions or billions of dollars. It's ridiculous to think that it does. So, you've got people have just become very, very short-term focused, to the extent where a 30-second TikTok video is too short for them. So it's not a surprise that we see investors bouncing around like idiots. That's your advantage, to not be caught up in that it's dangerous it's dangerous to be playing in that space. If you want to gamble, go and gamble and get all your kicks at Vegas. But it also means that there's an extraordinary opportunity for anyone that doesn't play that game, because sadly the vast majority of people are, including institutional money, because at the end of the day, institutional money is just catering to what people want.
Yeah. And by definition, buying low implies that you're buying when no one else is. Otherwise, if there was a bid, then everyone else would buy low. So by definition, everyone can't buy low, because if everyone bought low, it wouldn't be low to begin with. So
yeah. And it's the hardest thing in the world, Dan, to go and buy this stuff. And when we bought Argentinian assets, what was that, 2.5 years ago, Chris? When no one else would touch these things with a 40-foot barge pole, we would have thought we're clinically insane. So many people thought we're clinically insane. We started thinking, well, cheapest maybe we are. But anyway, we'll hold them anyway. And then, boom, off it they took. So, all very well and saying, yeah, buy things when they're low, but it's darn hard. All very, very well saying be patient, but watching something go nowhere for 2 or 3 years is just, when everything else is doing, well, many other things are doing okay. It's like, that's really difficult as well. And you question yourself. But hey, I think you've probably been around long enough now, Daniel, to start seeing that, patience does reap huge rewards.
Yeah, yeah. I mean, I mentioned, I've been subscribed to your newsletter for quite some time now. I've seen some pretty spectacular gains with a number of different picks that you guys have outlined. Can't recommend your newsletter enough. Again, the link to that is down below. Chris and Brad, thank you so much for coming back on the show. Really appreciate it. Go ahead and drop your socials, guys. Where can people find you?
So you can just find us at our website, which is capitalistexploits.at. A for apple, T for tomato. And then on the institutional side, glenorchycapital.net. And that's Glenorchy as in Scottish name, CHY, Glenorchy. That's it. We've got a Twitter account. I can't even remember what the damn thing is. I think it's at Capitalist EXP.
Yeah, I think that's the case. I'll look it up and we'll post it on screen so people have
Thank you.
Cool.
Danny, thanks so
Hey.
much. These are great. Always look forward to doing them.
Yeah.
Thanks.
Any closing comments before we sign off?
Just
No. Life goes on.
portfolio
man.
allocation. Don't get caught up too much in one thing, and keep your head about you.
All right.
The best is yet to come. Of all these things, we have many folks are doing exceptionally well, and all of the things most of the things we've been talking about. But we still think the best is yet to come. We've got
excellent. Well, hey guys, if you enjoyed this video, be sure to give it a like, subscribe to the channel if you haven't already. Comment down below. Let me know if you agree or disagree with any of Chris and Brad's points. Happy to kind of have a little comment section down there with some disagreeing opinions. I'll be happy to reply. So comment down below. I'll try to reply to as many as I can. And if you want to support the channel, you can buy me a coffee. Link to that is down below. Check out Chris and Brad's newsletter. That also helps the channel in its own way. And with that said, I will see you in the next episode. Bye, y'all.